Net worth versus passive income. Two concepts rarely taught about in school, but crucial to you achieving financial freedom. If you've ever wanted to get out of the rat race, you've probably heard these terms and know how indicative they are to financial success. In fact, these terms are often used in finance almost interchangeably when they shouldn't be. So today, we're going to talk about not only what they mean, but how they're calculated, and most importantly, which one you should be pursuing. Don't forget to turn the like button blue, subscribe, and if you're really real, turn on notifications. Let's get to it. First off, we need to know the difference between net worth, passive income, and even cash flow. Net worth is what you own minus what you owe, aka your assets minus your liabilities. One of the first rules I learned about money is that assets are what puts money in your pocket and liabilities are what take money out of your pocket. So if someone has a very high net worth, that doesn't necessarily mean that they have that much cash in their bank account. It usually means that that's the value of the assets that they own. Real estate is one of the most talked about asset classes because property values tend to increase over time. If you want to see a deep dive on 3 real estate strategies that are good for investors, I'll link to this video at the end of this one. And if you want to see a tour of my first investment property, which is a duplex, I'll link to that as well. Of course, when we talk about assets, people are going to argue over whether things like a car or a house are true assets, but I think that own minus owe is a good working definition for us to start with. Next up, passive income. I'm actually going to break this one up into 2 different categories, passive income and cash flow. We'll talk about passive income in terms of the money that you make or lose from your investments, and cash flow will refer to your personal budget. So the money that you get from your job as well as your expenses like groceries and Netflix. But both of these things can be described as income minus expenses. So what matters more, your net worth or your passive income and cash flow? I won't just give you the generic "it depends" answer. In my opinion, and feel free to disagree with me in the comments, I'd love to hear what you guys think, but I feel like net worth is less important than your passive income and your cash flow. Now, that's not to say that they don't all have immense value, but I think that net worth is something that you should keep track of on a yearly basis, and cash flow is something that you should actively pursue every single month. Let's explore this using some numbers as an example. We'll start with net worth. So first, we're calculating what we own. We've got a $200,000 house, a $30,000 car, $10K in savings, and $5K in stocks. Whether these numbers match up with yours or not, you can do the math particular to your situation. But in this example, this person has $245,000. Now we take out what we owe, a $150,000 mortgage on that house, and $25K in student loan debt means we have $175,000 as liabilities and a $70,000 net worth. Now, this tells us some valuable information, but it leaves out a lot as well. We know the value of the assets we own, but we don't know how much real cash they're actually bringing us. Sure, I know that I have $5,000 in stocks, but what does that mean for the money coming into my bank account every month? Do I get dividends every quarter? Do I reinvest the profits and keep them within my portfolio? I don't know any of that information if I'm just looking at net worth. Assets are by definition supposed to bring us money, but certain assets can be pretty costly. Common examples of this are your house and your car. While your house may be worth $200,000 with an $150,000 mortgage, that's not your only expense. The cost for repairs and HOA payments and utilities can all add up and be pretty expensive. As for your car, that's actually a depreciating asset which goes down in value every single year, unlike your house, which under normal circumstances should be going up in value. And similarly, your car has extra expenses as well. Maintenance. You know that if you've ever taken your car to a mechanic, they're going to tell you that there's a million things wrong with it, and you'll end up spending much more money than you anticipated. You've also got gas and insurance and things of that nature. So while it's good to know the value of the assets that we own, we also want to know what the actual cost of owning them is. We know how much debt we owe, but we don't know how much interest on top of that debt is costing us. One of the biggest drawbacks I see to how net worth is often calculated is that it usually leaves out these interest payments on top of your debt. And interest is one of the reasons that so many people have trouble paying back debt like student loan or credit cards. In our example, we said that we have $25K in student loan debt. So on a 10-year loan at a 6.8% interest rate, that's going to cost us about $290 a month. Now, though we borrowed $25,000, when it's all said and done, we'll have paid back $35,524. That extra $10,000 of interest is crucial to how we live our lives and what our budget looks like. And it's missing when we only look at net worth. The final limitation of net worth calculations is that we know very, very little of what our day-to-day spending looks like. Someone can have a crazy high net worth, but if their spending is just going crazy and they're burning through all of their cash, eventually they're gonna have to sell their assets to keep up with that spending, unless the cash flow that they get from their assets is greater than the spending that they're doing. So how do we define cash flow? Income minus expenses. If that income that you're getting is from a rental property or an online business that you don't have to work in day to day, then that cash flow becomes passive income. You can cash flow positive or negative regardless of your net worth. And that's why I think it's the more important thing to keep track of and to pursue. Let's look back at our example and imagine what this person's monthly cash flow might be. Someone with an $150,000 mortgage probably makes around $60K a year, so we'll average that their take-home pay is around $4,100 a month. That mortgage will result in a monthly payment of around $1,000, $540 for a car payment, another $400 for gas, maintenance, and insurance, $250 for utilities and Wi-Fi, $300 for groceries, and $290 for our student loan debt. We'll finish up by saying another $500 for things like your phone bill, groceries, Netflix subscription, all that good stuff. All of that means that our monthly cash flow would be around $820. And whether off the bat that seems like a high number or a low number to you, notice that that's not even enough to cover the next mortgage payment if this person loses their job. And we haven't even put anything in savings yet. So technically this person's living paycheck to paycheck. That's why I think this cash flow number is much more important to know and keep track of than your net worth. It's like your day-to-day life depends on your cash flow, whereas your net worth is something to keep track of and to strive for, but it doesn't actually have that big of an impact on how you live every single day. Like, who cares if this person has a 70K net worth if they lose their job and can't pay their mortgage or buy food? Something else to note is that in this example, this person has no passive income. So let's see how that might change things up. Most households in America spend upwards of 37% of their take-home pay on housing, and in our example, they're spending about 40%. But how would things change if they tried a real estate investing strategy called house hacking? Imagine that house was a $200,000 duplex like this one I found in Columbus, Ohio. It has a 3-bedroom, 2-bathroom that rents for $1K a month and a 2-bedroom, 1-bathroom that rents for $850. Now, let's imagine that our example person lives in that 2-bedroom, 1-bathroom unit, so they're not going to get that $850 in rent. But they are going to rent out that 3-bedroom, 2-bathroom unit, so they have $1,000 coming in rental income. That covers their entire mortgage payment and leaves their cash flow situation looking like this. That's a big difference. And that's the power of knowing your cash flow and your passive income and not just your net worth. It allows you to make changes to your lifestyle so you increase the amount of money that you're saving and investing, which will then in turn increase your net worth. If you want to learn how to increase your passive income, make sure to subscribe and turn on the notification because I'm starting a new series on this channel. The first video is going to take you from $0 to $100 a month in passive income through things like online businesses, real estate, or side hustles. If you enjoyed this video, you'll find another one from my channel specifically recommended for you right here. And if you want to see that video of 3 real estate strategies that are great for beginners, you can find that right here. I post videos most Tuesdays, Fridays, and Sundays, and until next time, thanks for watching.